some of the best free investing wisdom you can find out there would be reading through Warren Buffett's shareholder letters. But you need to be very careful because some of the advice that these gurus give can be taken out of context. And this particular example here is quite a good one. I came across this statement. He said, very few people have gotten rich on their seventh best idea, but a lot of people have gotten rich with their best idea. So that's false, right? If all it took to get rich was a good idea, then everybody would be a millionaire. So that's rather misleading. He goes on to say, so I would say for anyone working with normal capital, let's assume they means unlevered capital, who really knows the businesses they have gone into, 6 is plenty. So the key words here are really knows the businesses, and the extent to how Mr. Buffett goes about doing that is his secret sauce. Now, he also talked about diversification as follows. He said, diversification is protection against ignorance. It makes little sense if you know what you are doing. Okay, so we shouldn't diversify, right? He says, diversification may preserve wealth, but concentration builds wealth. So the conclusion here is that if you know what you're doing, concentration can build wealth. So let me ask you this. How many newbie investors know what they're doing?
I have absolutely no idea what's going on.
How many total investors know what they're doing? So it's the idea that, you survey a group of people and 75% of them will say they're better than average drivers, right? So as we all know, based on experience, being a newbie investor is when you typically make all the mistakes in the book. And what newbies will usually do initially is latch on to whatever charlatan happens to be spinning the best yarns. Now, there's one big problem with that. And I love this picture. When I first came across this story, I found it to be so fascinating. It's quite popular on social media now. But this was in World War II, and all the planes that were returning back after bombing runs, they analyzed them and say, where are these planes getting hit? And across the population of planes that returned, they marked all these spots. And the engineer said, all right, let's go ahead. We need to reinforce all these areas. And then one gentleman said, no, where you need to reinforce are the areas that haven't been hit, because the engines, you can see in the cockpit, obvious examples there, when those get hit, the plane goes down. So reinforce all the areas that aren't in red. You don't need to worry about those. And he was absolutely right. That's a classic example of what they call survivorship bias. It's a form of selection bias that can lead to does this sound familiar? Overly optimistic beliefs because multiple failures are overlooked. In other words, retail investors, especially in today's environment of social media, all they see are what we call armchair BSDs. It's big swinging dicks. So there are 24.5 million millionaires in the United States, and 49 million of them are on social media. I came across one recently. He says, I pick stocks. That's what I do. Well, that's the problem, because you're almost certainly going to underperform the market over the long term. So anybody that's following you is going to follow your underperformance. And of course, in a bull market, everybody's a BSD, right? People who claim to be superior stock pickers, they wear their naivety on their sleeves. And in the world of clout, who the hell is checking? And it's gotten rather out of hand. And that's why I enjoy our brand, because it brings people back down to earth. You'll see statements, check out my $10 million portfolio. Well, there's, of course, Adobe Photoshop. Some people are doing that, guaranteed. There's no reason not to, unless, of course, you have integrity. But the assets that you're invested with or that you're managing, they're relative, so the best way you can relate to people is using percentages. That's what we think. There are now platforms for these 25-year-old life coaches to post their portfolios. Well, when everyone's a stock expert, then nobody's a stock expert. So what you need to be careful there is that past performance, or all new, isn't indicative of future performance. So give it a couple decades to see how they did. Well, that time, right, you have to make the punt in advance. And as I said, you need to think about the fact that 95%, and we're going to talk about this, of professional investors can't beat a benchmark. People say, well, is that the exact number? We're going to talk about that. So also you'll hear people say, well, I'm young, it's okay. This is correct that when you're young, you can afford more risk, but you need to be very careful there. Why? Because the earlier you start, the wealthier you become. And I like this chart here. It shows Jack and Jill investing some money over time. And He invests, between 25 and 35 and stops. She invests between 35 and 65, and he still has more money. So he invested for 10 years. She invested for 30 years. He has more money. Why? Well, it's the value of money over time in the market. So on average, you receive 6.6% per year in the stock market, inflation adjusted. Another thing that retail investors will say is, I'm going to read some books. Well, let's compare Joe Retail Investor hungover scratching his ass on a Saturday morning, glued to his MacBook. Let's compare him to a seasoned finance professional working 60 hours a week. So what retail investors may not know about hardcore finance is that it's very, very tough to get in. First, you need to be accepted to extremely selective programs, probably a post-grad as well. You need to graduate top of your class to make yourself stand out because all your other classmates are gunning for the same job. And you need to do extracurricular things at the same time so you can show how special you are. You have to network until your hand falls off or all the pretentiousness suffocates you. That was the avenue that worked for me. And then you work your way to a point where you can make some decent money. So that's how a career in finance works. That's just to get in the damn door. So who needs all that? I'll buy a few books and be ahead of them. Okay, well, probably not. What few newbies understand as well is how many ways there are to lose money. We call these the tourist areas of finance. So when you go to a foreign country, anytime you go to a tourist area, that's where all the crime is, right? And it's obvious reasons. So there's suckers around. People are there to fleece them. Very few people I've seen over my career and the time we've spent here at Nanalyze helping people become better investors, very few people, myself included, have ever navigated all the pitfalls. Here are some. You have OTC stocks. These were the OGs of SPACs. And the crime there, I think that at some point they even had the mafia, multiple mafias operating there. It was fleecing the sheep. Classic movie, Boiler Room. That's going to show you what's going on there. Then you move to, hey, you know what? It. We're just going to show investor decks with all these grand claims and get them to invest in these quote-unquote IPOs for the common man, SPACs. It was garbage. Pre-revenue trash. Don't invest in any company that doesn't have revenues, period. You had ICOs, NFTs. These are so obvious. It wasn't barely worth the money we spent to publish pieces warning people, but it was a good thing we did. Crypto in general. Stay away from that stuff. It's horrible. We've done pieces on this. In its state today, when you have a space that requires a startup just to navigate and compile all the scams into a report every year, that tells you that something's wrong there. Micro caps, these don't outperform statistically. Small caps versus large caps is a different discussion. We're talking micro and nano. Story stocks, small pharmaceutical firms, we see a lot of people chasing those. Some great drug on the horizon, a lot. Doctors sometimes, going back to Boiler Room. People say, are these scams? Doesn't matter. Doesn't matter if it's a scam or if the management team is entirely incompetent, you're going to end up with no money. So what investors will then say, I'll ask the experts, right? So Buffett did XYZ, I'll do XYZ. Well, you can take select bits of wisdom from every person on this page, not all the things they said, as the point of this presentation is going to make. You can take select bits of wisdom, but ultimately what you need to do is develop your own basic strategy, become comfortable with it, and refine it over time, and that evolves as you age. Now, people often say, we talk about diversification, say Peter Lynch disagrees with you, start talking about 10 baggers and stuff. Don't like that language. First of all, Peter Lynch never said he thought the average Joe should stock pick. He said if they did, if they choose to go down that path, they're automatically relegating themselves to a 90+% probability of failure at doing that. We could say this. What does statistical evidence show us about professional investors' ability to generate alpha? So let's assume, for the sake of argument here, that people who dedicate their lives to investing professionals are better than weekend warriors, all right? People on these Reddit groups, we're beating Wall Street, might be the dumbest mantra yet, clearly don't understand how the world of finance operates. The ability to generate alpha is actually decreasing over time. There's a number of reasons for that. First, the market is becoming more efficient over time as more info is made available. So that means that there's less arbitrage opportunities, less alpha to capture. A lot more money is chasing performance. a lot more sophisticated money, especially firms like Renaissance. It's absolutely mind-boggling how well Renaissance has performed. And how do they do that? Well, they did that with technology. And there's also a lot more people to target with trash, newbies, naive individuals. You see here on the right, this represents retail investors' float, so the volume of retail investors. And that's why you've got SPACs, NFTs, pictures of rocks, anything they can sell to fleece these people with. And this very important fact here, this is a good article, and you can Google it. More evidence that it's really hard to beat the market over time. 95% of finance professionals can't do it. The point is that the further you go over time, the less likely it is that you're going to beat an index. We see a lot of beginner's luck when it comes to investing. So what does computers say? Well, let's just say that 90%, we'll call it 90% of investors can't beat a benchmark in the long run, whether it's 15, 20 years. Okay, how can you beat 90% of investors? You just invest in the benchmark, all right? But that's boring. Yes, it is. And that's where people say, well, I want something exciting, I want some stock tips. Well, first of all, those don't exist because insider trading is illegal, and all that is just some rando telling you what they think you should do. Never take advice from people who don't have to live with the consequences, and be careful there, because then you'll see these people on social media that chase clout. They'll say anything. Be real careful about the 25-year-old life coach, going back to that whole newbies thing. And what you'll find, and we see constantly these instant analysts, they're all passing around the same tickers. Why is that? Well, by complete accident, of course, they happen to be the most searched for tickers. Now, that could be a chicken and egg situation there. The point is that whatever's popular is going to get you more clout, and that's all they talk about, and that happens to be what their portfolios are. Okay, guys. So a typical thought process when it comes to investing, people say, well, I think technology is bullish. Well, you're joking, right? That's where most people seem to start their investing journey. They'll say, I use Google a lot, Microsoft, Meta's model agency app. So I'm going to invest in Google, MSFT, Meta, top it off with some NVIDIA call options for good measure. So they have exposure to 4 companies, 25% each, job done. Well, first problem here. Stocks of a feather behave together. They're all technology stocks. What else? They're all large cap. What else? They're all U.S. companies. This is a highly correlated portfolio. So what opportunities might you be missing there, Nostradamus, when you go full-blown into large cap U.S. tech stocks? And these weightings are quite heavy. And I'd say, above 10% is a traditional cutoff for portfolio managers. That's what we use. Well, people say, well, Buffett's at 50%. Again, you're not Buffett. Most people aren't Buffett. The vast majority of people are never going to even come close to what this man accomplished. He never risked more than 50% of his assets on a single company, so that should be your maximum cutoff. And remember that this guy buys companies, not stocks. He doesn't YOLO into a stonk using his Robinhood account on a balmy Omaha afternoon because he's bored. Top investors who wrote this stuff, top investors have relationships with management teams. So Buffett does that, and he takes big stakes. He has influence at the board level. Okay, so think about, well, as an investor, what value could I bring to the C level for a company I invest in? Probably none, right? How capable am I of assessing competency at that level? Probably not very good, right? So that's the sort of advantage that Buffett brings to the table. Now, he was successful because of his strategy, not his stock picking skills. So some profiles that we can think about when it comes to investing. You have 3 profiles I wrote down here. If you're a student, early 20s, you have 10K invested. You really should be focused on your studies. If you're in your 20s and you put all your money on a single stock, how often are you going to be checking that ticker all day, right? That's a distraction. So senior associate VP, mid-30s, 100K after student loans. This is the most attractive profile because these individuals can dollar cost average. Now, this only works with high quality assets because you don't want to chase falling knives. When you start to accumulate wealth and you start to think about preservation, then you have the doctor example here, somebody with $4 million liquid net worth, dabbles in the market with some of it, really needs at that age to think about asset allocation. A planner isn't the worst idea. Why? Because that person's very busy, and you'd probably want to use multiple planners, right? And make sure there's some checks and balances right there. But all 3 of these profiles, you see, it wouldn't make sense to be highly concentrated in a small number of stocks. And people say, Well, what should I do? We're going to put out a piece next. Make sure you subscribe. That's going to look precisely at the move from that student to that senior associate in your first 100K. So in all cases, you always want to start at the top, asset class allocation. What's an asset class? Well, it's stocks or bonds or real estate. So people that go all in one stock, they have one asset class. It's a single stock. You have alternative asset classes, interesting bits like gold and Bitcoin and stuff like that. And what you end up with then is a portfolio that looks like this. And this is our portfolio we manage. Well, there's multiple portfolios in here. We have Quantigent's DGI portfolio. Nanalyze is a tech portfolio. You can see some other bits and bobs. And what you can do is say, all right, if a dirty bomb goes off in New York, here's how the different asset classes that I hold will react. So we used to shock test portfolios, and you see, well, if there's a dirty bomb, S&P down 30%, tech stocks down 50% because they're way more volatile. Europe's flat, Asia's up 5%, cash flat, alternatives up 10%. So you see then that having a diversified set of assets helps you navigate through uncertainty, which inevitably there will be uncertainty, quite well, so that you sleep well at night. That becomes more important as you age. And it's not about how much you put into the market. It needs to come from somewhere, of course, but it's how long you stay in. So managing a portfolio is also adjusting weights. You kind of become your own benchmark. And when stability starts to become important in your life, okay, moving from concentration where you have all this volatility, upwards, downwards movements, the amount of money, your wealth is just, it's vanishing before your eyes. It goes up and it goes down. It gives and it taketh away. The questions you start asking yourself, because now you're busting your ass in some less than fulfilling job, typically, if it's making any a large degree of money, the odds that it's extremely fulfilling is become lower. Do I really want to be stuck in this crummy job? How do I know I won't run out of money if I leave? Can I take the leap of faith and do what I want with my life? That's where that you start to move a little away from concentration into diversification. Now you see where kind of as you're progressing, the more money you're getting and the older that you're getting, that move from concentration to stability becomes very important. That's why we built Quantigents. And when you think about the S&P 500, so one of the most commonly used benchmarks, the longest drawdown period was between August 2000 and December 2013. So it reached a trough of 60%. So imagine 60% of your assets going away. Well, that was kind of extreme. You'd expect drawdowns of 30% to be more the extremes. You can see some here where it would have drawn down 30%. And if that's pretty palatable, really, if you think about it, if you had $300,000 and you went down $200,000, I don't think that's the worst thing. And you certainly would start to look at that with some concern. But that's just using one of the most popular broad index measures. Now try that with tech stocks. So try that with one stock. Now you're going to start sweating it. Parting thoughts coming next. We're going to look at a best of both worlds approach. It teaches you, it helps you manage emotion. It doesn't involve anything except a broker and your conviction. So in the comments section, please spare us all the man bites dog stories. We know you're a BSD and it worked for you. That's the very, very rare exception. Instead, how about you tell us a time you really had your ass handed to you? And we've done that in this next piece here. I think there's a lot of lessons to be learned in this company we invested in that went bankrupt. So please make sure to subscribe to this channel. You don't want to miss the next video out on this topic. Thanks so much for taking the time to watch this today.